Eric Muadit, Muadit.com, with another mentorship video. As discussed earlier, just want to show you what the Nasdaq is doing here. There's two lines that I think we should be very sensitive to. Right now, it seems like everybody is expecting this market to continue going down. This is a 5-year weekly. As I mentioned, I was going to send you this analysis. So 5-year. Oops. It's 5-year weekly. And right now everybody's expecting this market to continue dropping because it is about to move to fresh weekly closing lows going back to 2014. So if it cracks this level here, anything below here, and the market is going to be recording fresh weekly closing lows going back to 2014, somewhere here. But I think there's another way that is a little bit of a tell that if the market chooses to, it might actually bounce. And I'll show you two lines. So line number one is quite simply the line connecting the lows of 2011 and the lows of 2015. Extend that line. And you can see that it is coming in contact exactly where we are trading right now. Okay. So that's one line. And then the other line is the uniformity line. And we'll go into detail in subsequent videos about this method. This method just tries to figure out where a move began. And we can see here that there's a move that began right here off the lows there. And so we can draw a line from here. So we know that that was successful. So from here and this lows, the market would go on a major run. So we use that information. And again, this is a uniformity method. And that line should look like that. Now you'll notice that this line so happens to be above or at about 38.2. And we can test that. It was the lows here. So every time the market hits that line with uniform action, we know it's a signal of a turnaround situation. Double bottom support here for the lows there. Uniform activity support here for the lows there, and uniform activity support here for the lows there. This was a triple bottom. All of this was support at the green line for the lows somewhere here. And now all it takes is a slight move and holding above this green line. And if we see this market turn positive for the week and showing support on the green line, that would indicate short term that this market is now pointing higher, and we should respect the potential for upside move. So that's why I was saying, even though yes, I do agree it looks bearish right now, but we have to be aware that this could actually turn around if this weekly chart holds on those two lines. So again, we get line number one, green line. That's the first line that needs to hold or might hold. And then the second line is this line here. So if both hold, chances are very high. So if this is support at that or those two lines, chances are very high your markets are going to have to bounce before they ever see lower prices. And sometimes this bounce can actually be good enough to take the markets to new highs. So let's be aware that that is the risk for anybody thinking the market cannot go substantially lower. Now, of course, we know that the monthly chart, as discussed, has the risk right now of slashing through 50. If it slashes through 50, that's going to be a bad signal short term for those who are bullish. And we can see here that the monthly lows are being tested. Monthly lows for 2015 plus are being tested right now. They are holding. And we can see that MACDs are fresh lows, or at least the main MACD. Secondary MACD is breaking down and also moving below zero. So lots of bearish signals, which is obvious, which is why we've been short the last couple of weeks or so. And the one thing I want to point out here is this market doesn't recover until, first and foremost, it moves above 30.90. So as long as it is holding below 30.90 on the daily, even day to day, there's not going to be any type of a bounce. So first and foremost, order of business is moving above 30.90. Just for example, like it did here, It's only after it moved back above 30.90 here that the market recovered. Here it tested 30.90 and held for these lows there. So right now, trading below 30.90, the risk is still to the downside. It's only when it recaptures back above 30.90. And so let's watch that weekly chart. I know it's something a lot of people might not give a lot of weight to, but this has been holding since 2011. And if it holds again, so these two lines, if they hold, I can assure you that the market might have enough strength to actually even test some of these recent highs. It is not out of the question. So that's the risk if you are short, which is the situation here, that if this weekly chart holds, the market might bounce. How much of a bounce that can come out of that, who knows? But once, if and when this is confirmed as support with uniform action, just be aware the market could actually bounce. Otherwise, for now, the weeklies, actually even the weeklies, monthlies and dailies look bearish, but this is the risk if you are short. All right, talk to you later. Keep me posted. I'll keep you posted. Eric Muadh, good luck. Blessings. I am out. Woo!